Today I'll discuss with you why you should invest into mutual fund. Before going into this particular topic, we need to understand what is mutual fund. See, mutual fund nothing but a vehicle through which you can invest into different asset classes. Which are those asset classes? Like direct equity, bond, gold, real estate, etc. You invest through mutual fund because you might not have enough knowledge about these asset classes. Second thing is maybe you don't have time enough. Third, maybe lack of interest. But if you think about inflation beat return, then you should think about vehicle which is investing into direct equity. So one of the very good vehicle is through mutual fund. So in mutual fund, what happened here, someone who is very much knowledgeable, they and their research team, they involve and they invest on behalf of you. So you no need to invest directly. So on behalf of you, some expert will invest and they will manage your portfolio. So after spending a good amount of time in the industry, my view is all products are good in their own ways. And investment is nothing but the management of risk and return. How well you can manage your risk and return, that much you can generate your wealth. So let's understand it by one simple example. Today, you know, one of the fastest way to travel one place to another place is rocket. But you cannot go everywhere through rocket. So for some places you need to take aeroplane. For some places you need to take helicopter. And for some places you need to take your maybe train. Some places maybe by road is the best way to go. So you need to understand your need, your risk appetite, and what is the risk involved in investing in each asset class. What is the risk and what is the return? So the basic concept means the basic concept is if risk is higher, return is higher. If risk is lower, return is lower. But by strategy with that risk and return adjustment, I do agree in some cases concentrated focused direct equity portfolio may give you better return than mutual fund. But how many of you have real knowledge of equity and how many experts are there in the industry? So if you don't have much knowledge, then just believe in who are the recognized expert in the industry, and you need to understand what is your risk appetite as well. So based on that you need to do your investment. I'll come in this series in my upcoming video in-depth analysis of each and every types of mutual fund and some of the real-time scenarios, I'll go and deep dive into 1-2 mutual funds so that I can explain to you why I personally recommend everyone to start their community to manage your portfolio through veteran expert of the industries. You also can go and open Demat account and invest into direct equity. But the problem over here is to manage this Demat account and invest regularly. So people may not comfortable with that, and managing one more account maybe it's a headache for them. Second thing is affordable portfolio diversification. So to invest into mutual fund, you no need to have very huge amount. You can start your investment monthly. You can start your investment by $500 and you can start SIP. So with diversification, one investor ensures that your all eggs should not be in one basket. But say for example, if you want to invest today, maybe share like MRF, share like Honeywell Automation, share like About India. These all shares are once About India, one share price is around 15,000-16,000 today. Okay. Then Honeywell Automation is around 45-50 के range में. So by 500 rupees you cannot purchase this kind of quality stocks. Okay. Here what had happened, when it is pool of money and they actually purchase in one mutual fund, there might be 40-50 stocks. Okay. And you will get proportion of your unit, your amount, that proportional you will get units from this particular whole sum of chunk. So that is why with minimum cost you can diversify your entire portfolio, and which will reduce your risk. Next is economic of scale. Because when it is a mutual fund, here large pool of money, it is like pooled in one place. So you can involve one very good research team and one fund manager, very veteran fund manager would be there. They will manage your investment. So if you have small money, you may not engage such kind of researcher for your investment. So they have their own cost, own salary, then their office maintenance cost plus research cost, miscellaneous cost. Here what is happening? Here, as it is a pool of money and it is a large pool of money they are managing, so per unit this costing is coming very negligible. So that is why with a minimum cost you can manage your good amount of money. Liquidity. Say for example, sometimes you directly invest into some corporate securities, and at the time when you need money, immediately you cannot get buyer to sell the securities and come out. Sometimes it is like it's very difficult for you to get quality companies, but through mutual fund, so everything is managed by professionals, and most of the time it is very much liquid. Equity fund, anytime if you want money, they will give you money because they manage one cash ratio over there. First thing. Second thing, equity, it is totally liquid. If they get buyer, immediately they settle and give back this particular money. In debt market also, most of the time you will get money immediately. Then tax deferral. How it works? Say for example, if you invest into direct equity or direct stocks, whenever you sell the stocks, you need to pay short-term and long-term capital gain. But investor in a mutual fund, whenever fund manager churn their portfolio, and again it invest into that particular stocks, so it will not taxable in your hand. You will be taxed when you come out from mutual fund, and that point of time what will be the gain? On that gain you will be charged based on short term, long term, you will be charged short term or long term capital gain. Next, tax benefit. In mutual fund there is one fund called ELSS, Equity Link Savings Scheme. This particular mutual fund has 3 years lock-in, and investor can take tax benefit under section 80C. So in market, if you see apart from this other investment vehicle like fixed deposit, minimum 5 years lock-in is there, and interest rate is like debt interest rate only. If you go to any insurance, that is also 5 years lock-in period would be there. But when it comes to mutual fund, it is only 3 years lock-in period would be there. You can get equity flavor as well. So here investment also very convenient. So one time you need to do your KYC. After that you can invest anytime. So right now, like you can invest through different apps like Angel. Very easy to invest nowadays. It is very convenient to invest, and withdraw money also very convenient. You can get money once you give redemption. Maximum after 2 days you will get money to your account. Now in mutual fund you can invest through systematic approach. What are those? One is SIP. SIP is nothing but systematic approach. It is like every month you will invest into mutual funds. Every monthly basis, like whatever you can save, that particular money automatically it will go to your mutual fund account. Like your EMI. Here you are not paying your loan, you are investing. Next is systematic transfer plan. Systematic transfer plan is nothing but it is like you'll invest into one fund and automatically you can transfer from one fund to another fund. So it is very useful. So see, actually one way to look into this is, say for example you have maybe 1 crore or 50 lakhs or 25 lakhs, maybe you have lump sum. So you can put this money into debt fund. Debt fund is very stable kind of fund. From there, every in certain period, like weekly basis or monthly basis, some amount may transfer to your debt fund to your equity fund. What is the logic behind that? Because equity is very much volatile. So when it will go in every different time horizon, your rupee cost will average out. Costing will average out, and then when market will go up, that point of time you can take out your money. So this is the thought process behind that. Vice versa is, say for example over the period of time you accumulated some money and you are near to your retirement. So what you can do is, from that equity fund systematically you can transfer your money to your debt fund. That is also can be possible, and that money you can, because this is investment, so managing market volatility risk, and we are averaging out rupee cost, and this is we are managing actually market falker risk, and we are just systematically transferring to debt fund which is stable enough, and from there you can do systematically withdrawal. So that is also possible. So different strategies are there. So I'll go in depth into different videos so that I can explain to you in details each and every strategies and how you can be benefited out of these strategies. So now let's understand what is the limitation of this particular mutual fund. Okay, so first limitation is, like PMS, this fund you cannot customize. It is for mass. So it is a huge pool of money, and so it is for entire mass. So you cannot customize this particular portfolio. It depends on what fund manager will think. Based on their thought process, they will manage your large chunk of money. This is one part. So there are around 40 mutual fund houses are there. They have totally more than 1200 kind of schemes are there. So one layman investor can be confused between scheme, and based on their risk appetite they cannot directly understand which mutual fund is good for them and how. So for them they need to involve one mutual fund advisor, and good mutual fund advisor can guide them properly. Next limitation is, mutual fund is pool of money. So there are so it involves lot of cost, so which they need to bear. Okay, so one single investor does not have control on the cost of this particular mutual fund. So this is one of the one more limitation. So hope you understand this particular concept, and I always believe mutual SIP is one of the very good way to start your investment, Going forward, start with SIPs, start with mutual funds. Once you will get familiar with equity investment, how market cycle works, how particular equity works, how gold works, how real estate cycle works, how different asset class work, then you should involve into one particular asset class. Most of the places people are still very much familiar with gold and real estate, but equity is an asset class which is giving highest return from past 40 means around 40 years, highest average return. If you want inflation beat return, definitely you need to invest into any form of equity like direct equity or equity mutual fund or PMS. Any form of equity you need to invest based on your risk appetite, cash flow, and overall asset allocation. Lot of factor you need to take into consideration. For that, definitely you need to discuss with mutual fund advisor. Thank you.